The Indian economy had a tough few months and a tough year. Growth has repeatedly declined, and in particular, over the summer and into the autumn, India was front and center as capital fled from major emerging markets, and the rupee went down by almost 20%. It's recovered since then, and so the fact that the market has come up, I think, is more of a factor of great relief from investors that things aren't quite as bad as they thought they might be. I think a lot of the turnaround has come because of what happened in the United States, not just the decision to postpone the taper, but also the appointment of Janet Yellen, the end of the government shutdown. A number of factors have combined to lift the sense of crisis that hovered over emerging markets like India. But in addition to that, there have been a number of other mitigating factors from within India. The current account deficit, which is the source of a lot of the country's problems, has been going down much more quickly than anybody expected. The currency, after a torrid few months, has stabilized against the US dollar. And also you have the new governor of the Reserve Bank of India, the central bank, Raghuram Rajan, who took up his position at the beginning of September and is a popular and widely admired figure who has been seen to take some quite tough steps. What Mr. Rajan did today was exactly as expected. He did two things, one of which was to move up the basic rate, basic interest rate as an attempt to combat inflation, but he also, rather confusingly, moved down another interest rate, a higher emergency rate, which was introduced during the period of crisis in July and August. And so what this represents is India attempting to unwind some of the emergency measures which were introduced to protect the rupee in the middle of the year, and do so while also trying to crack down on inflation, which, as ever in India, is stubbornly high. But what you've seen over the last 3 or 4 months is a huge movement towards export stocks, in particular IT outsourcers and pharmaceuticals. They were the havens in the storm that investors moved to when everything else appeared to be going down the tubes. Actually, what's happened after that, and part of what's been happening in the market over the last couple of weeks, is that investors have begun to look around at other sectors which previously seemed too risky and have decided that they look relatively inexpensive. And so some other sectors that had been doing badly in the middle of the year, for instance, banking, had come back up again. It was one of the oddities of the crisis that foreign institutional investors didn't move very much money out of Indian equities. And that was mostly because, looking around the region, the top of India's corporate sector actually looks quite good compared to most other countries. You have a top tier of well-run, attractive, well-governed companies that international investors like. And you also have some sectors like the IT and software industry or pharmaceuticals, which are relatively resilient to depreciations in the rupee, and indeed they tend to be better when the rupee goes down. And so instead of a great fleeing from Indian equities, actually most investors sort of sat on their hands and decided to kind of wait out the storm. This is James Crabtree for the Financial Times in Mumbai.